Interest rates are rising at the fastest rate in 20 years, and mortgage rates are rising even faster. So for those of you coming to the end of your fixed term or trying to get on the property ladder, you could find yourself paying thousands more than you expected. In this environment, you need to make sure you are doing everything you can to get the best rate available. So in this video, I'm going to talk you through examples from clients that I have worked with and my own recent remortgage to demonstrate 3 big mistakes I see people making that leave them paying thousands more than they need to. And I'm going to show you the strategies that you can use to avoid them, one of which netted my client the equivalent of a 260% return over 5 years. Hello and welcome back to the channel. For those of you that are new here, hi, my name is James. I am a financial planner, and this is a place where you can learn to make smarter financial decisions. Mortgages are an extremely useful tool when used correctly, but I often see clients making silly mistakes that end up costing them thousands. In this video, I'm going to be demonstrating strategies that I have employed myself and with clients. Now, whilst these strategies were suitable for these individuals at that time, they may not be suitable for you. So please do seek professional advice to establish whether you should be using them. Mistake number 1. Over the last 13 years, interest rates have either been falling or flat. So when we get close to the end of our mortgage fixed term, it's often not at the top of our list of priorities because the longer that we wait, typically the lower rate we seem to get. But now, with rates on the rise, leaving it to the last minute could leave you paying thousands more in interest each year. This is data from the Bank of England that shows how mortgage rates for a 2-year fixed term have changed over the last 2 years for different loan to values. Loan to value means the proportion of debt you're borrowing against the value of the property. So a 75% loan to value, or LTV for short, means that you have a 75% loan and 25% equity in the property. And as you can see, the higher your LTV, the higher the rate you're likely to end up with. So if you were refixing now at a 75% LTV for 2 years, it would cost you about 2.88%, which is almost double what you would have paid at the start of the year when rates were just 1.57%. But here's the thing, if you'd been on the ball with your fixed rate set to expire in June, you could have fixed your new rate 6 months beforehand and got 1.57% and consequently saved yourself a hell of a lot of money. I'm going to show you the exact step-by-step process you need to follow to do this by talking you through my own mortgage because I'm executing this strategy as we speak. I currently have a 350k mortgage at a rate of 2.1%, with the initial fixed period coming to an end in November. 7 months prior to this date, so in May, I started working with our mortgage broker, Ben, to identify which banks would lend to me given my personal circumstances. We found that Santander was offering the best rate for a 2-year fixed at 2.59%, so we started an application with them so that by the time that June came round, exactly 6 months before my fixed term ends, I had an offer locked in. This is the thing. Your current lender typically won't even notify you that your fixed term is coming to an end until you're 3 months out. And even if you do get ahead of it, they'll only let you lock in a new rate 3 or 4 months in advance. But when you're remortgaging with a new lender, you can lock in a rate up to 6 months before your fixed term is set to finish. And the new rate will only start once the old one has expired. So I now have an offer at 2.59%. But I don't have to take it, which is one of the other advantages of getting an offer from a new lender. Because when you lock in a new rate with your current provider, that's it, you're stuck with it, you have to accept it. Whereas now, I have an offer of 2.59% and I can wait to see if anything better comes along over the next 6 months. Although Bank of England base rates are expected to rise, do not assume that this means that mortgage rates will also go up. Mortgage rates do not move in lockstep with central bank rises. Instead, they are set by individual lenders trying to manage supply and demand, but also by the markets. And as we've seen with other types of debt, like here with UK government bonds, yields rose in anticipation of central bank rate rises, peaking at 2.65%. But over the last month, they've fallen back to 1.86%, despite base rates continuing to rise during this period. And as it happens, the rates offered by my current lender have been falling. And if they ever get below 2.59%, I can just go with them. At the same time, if Santander reduce their rates, my broker will just give them a call and ask them to adjust my offer. So with this strategy, you are able to ride the market to find the best available rate over the next 6 months. To make this strategy even more effective, when getting offers from new lenders, make sure to add the product fees to the balance of the mortgage so that you don't have to pay anything up front, which means that if you do decide not to go ahead with this offer, you don't have to wait to be refunded these charges. And you can always change this to pay the fees up front if you do decide to go ahead. Also, using a good mortgage broker can be an absolute lifesaver. They're often aware of when banks are about to change rates before they become publicly available, and they'll do all the legwork for you, and it often doesn't cost you anything. Mistake number 2. 2 years ago, a client of mine bought a property for 600k, and they bought this with a 540k repayment mortgage. So that's at 90% LTV. And they had this on an initial 2-year fixed term. So now, 2 years later, their fixed term deal is coming to an end, and they're now looking to refix for 5 years. And the best available rate that they could find was 3.55%. At this point, they came to me and they asked whether I thought this was a good rate. And I said, it's definitely worth having a chat with our broker, Ben, to see if he can find anything better. Now, Ben confirmed that no, this was actually the best available rate in the market, but he noticed something else. Because my client had been making repayments over the last 2 years, his LTV had fallen to 85.33%. However, if they were able to bring their LTV down to just 85%, there was a rate available at 3.35% or 0.2% better. And to get the LTV down from 85.33% to 85%, they would need to make an upfront payment of £1,991, which may sound like a lot, but if they did so, they would end up making a net saving of £3,248 over the next 5 years. Or in other words, by investing £1,991 now, they're getting a guaranteed 263% return over 5 years. And I don't think you need me to tell you that you won't find a better investment than that. You see, mortgage rates tend to take a step up at every 5% LTV interval. So you typically get the same rate between 75 and 80, 80 and 85, and 85 and 90. You can see here how the rates for each segment have changed over the last 2 years. Right now, they're quite narrow, but there have been times when the differences have been vast, which is why it's so important to check if you're close to any of these levels before deciding on a mortgage. Now, there's another sneaky way that you can get a lower loan to value. Typically, lenders will only do a valuation of your property when you first apply for a mortgage with them or when you do work to it. So when you're remortgaging with your existing lender, they instead value your house in line with an internal index for house prices in your area. Your broker can tell you how your current lender is valuing your property, and if you find that the indexed value that they are using is higher than what you think the true value of the property is, well, in that case, you've lucked out, and it's likely that your current lender will offer you a better rate than you will get elsewhere. However, if you think that the indexed value is lower than the true price of your property, it may be keeping you above a certain LTV threshold and you may be offered a worse rate. So if you think this is the case, you can ask your lender to do a new valuation or apply with a different lender and they'll do a valuation as part of this process. Mistake number 3. Even with these tactics, it's likely that you're going to end up with a rate that is higher than what you were on before, and it's going to start putting pressure on your monthly cash flow. But we need to remember that even with these higher rates, we are still making money by having a mortgage. Take my new mortgage as an example. I'll be paying 2.59% to borrow £350,000. That'll cost me just over £9,000 a year in interest, but with inflation running at 8.2% per year, the real value of my mortgage is being eroded away. So next year, my mortgage will only be worth £321,000 in today's money. That's a net gain of 20 grand. So clearly, even with rates rising, we're still in a good position whilst inflation remains high. But that does not change the fact that we still have to find more cash each month to cover the interest payments. So what can we do about it? As a repayment mortgage, my monthly payments would be £1,870 per month. But what about interest-only mortgages? If I was only paying the interest, my payments would be just £755 a month. Now, typically, you can only get an interest-only mortgage if you have an LTV of 50% or lower. But if I did have a 75% LTV and I wanted to improve my cash flow, I could go for a split mortgage, where 50% of the mortgage is on interest only and the remaining 25% is repayment, which would leave me with monthly payments of £1,126. On the face of it, interest-only mortgages may seem like a no-brainer, but they are not for everyone, and you need to evaluate the benefits alongside the risks before you can decide whether they are right for you. So let's start looking at the benefits. Obviously, having lower monthly payments gives you more flexibility with your cash flow. I am disciplined and I invest all of that additional cash. But if I ever did get myself into a tight spot and I needed to rebuild my emergency fund, I can always just stop investing for a month or two to build back up my cash buffer. You do not have the flexibility to do this if you have a repayment mortgage. And by using this extra cash to invest in other things, I get more diversity. I do not have all of my money tied up in one house, and I can try and target higher returns elsewhere, which means that by investing, I plan on being in a position where I could pay off my mortgage if I wanted to, faster than if I was just doing monthly repayments. These other investments that I'm making are also typically a lot more liquid. So if I did find myself in a tight spot, I could call on them very quickly if I really needed to. However, money that is tied up in your home is stuck there unless you remortgage. And as we've discussed, when accounting for inflation, I'm making money on this loan. And obviously if I paid it off, I would be missing out on that opportunity. But we also need to consider the risks, and there are some big risks. The biggest being that instead of investing that additional cash, you end up spending it and you find yourself at retirement with a massive mortgage and no way to pay it off. Whereas with a repayment mortgage, it's a great way of forcing yourself to save money each month. By holding a mortgage indefinitely, you are at risk of interest rate rises. And if you do find yourself in a position where rates have risen a lot, you may struggle to make the monthly payments. Therefore, if you are going to be using interest-only mortgages, it often makes sense to fix your rates for longer periods of time. Because not all lenders offer these types of mortgages, you'll be narrowing your options, which may translate into higher interest rates. And finally, and most importantly, by having this debt, you will always have this hanging over you, which depending on your personality type may cause you a lot of stress. And you really cannot put a price on the feeling of being debt free. Now, if you found these strategies useful and you'd like to find out how we were able to save one client 124k on their mortgage, then you need to watch this video here, where I use other client examples to talk you through 3 big mortgage mistakes that everybody makes. I'll see you there.